world, both silver and gold are used in every single sector of the global economy. And so in the manufacturing sector, when you're looking at the slowdown in the global economy, that's where you would not see a squeeze, but there needs to be. And to me, a squeeze doesn't necessarily mean that there is a top on it and then it's going to implode. In terms of contracts, that could be applicable. But in terms of sound money, physical gold and physical silver, when demand in one area, let's say it's the manufacturing because of a global slowdown, happens in this area, well, look at what the central banks are doing. I do think that part of it has to do with the Fed being between a rock and a hard place, because much as they want to lower interest rates to stimulate more money printing and all of that, and therefore inflation. And certainly looking around the globe, geopolitics, we've got war continuing on between Russia and Ukraine. We've got still upheaval in the Middle East and actually between China, et cetera, and the looming potential war with Venezuela and the US, what's happening there. But I actually think that this is much bigger than that. I agree with you. And it really started almost this time last year, last January, when we saw a major shift in the gold and silver markets. And in terms of the spot market, which I'll come back to in a second, but typically in the US, this is a contract-based market. They're just selling and buying the futures to get that little pickup in, the difference between the two. However, what happened last January, you might recall, is a big shift in demand, so that instead of those contracts being traded, big entities were taking delivery of the physical markets. And so I think that what's happening today is really more attached to that as that trend cycle, where it was the paper contracts that were dictating the global price. I think now it's more the physical markets that are dictating that price, because in those contracts, there's no scarcity. They can create as much gold and silver as they want to. And frankly, I'm a little surprised that that's not happening more, to be perfectly frank with you. And I'm talking about from a government perspective, because a rising gold price is an indication of a failing currency and a looming crisis. And I find it really interesting, all of the talking heads on, Bloomberg and CNBC or any of those those supposed news channels that are pushing an agenda. And what are they saying? Well, if you're concerned about geopolitics, buy gold. If you're concerned about the overvaluation in the markets, buy gold. I mean, now when you hear those talking heads touting buying gold, it's not the contracts that a lot of the people are going to, if they really understand what's happening in the markets, because all you're getting there is a reflection of the spot market, but it's the underlying structure of the pricing mechanism that is now going to physical supply and demand, which is one big reason why silver has been outperforming gold this year.
A pivotal change emerged early last year when gold and silver markets began behaving differently. For decades, pricing was dominated by futures contracts. Paper claims traded rapidly for marginal profits. Then demand changed. Instead of rolling contracts, large institutions began requesting physical delivery. That shift altered the pricing engine itself. Unlike paper markets, physical supply cannot be expanded at will. Scarcity suddenly mattered again. This transition helps explain why silver, with its tighter supply and industrial demand, has recently outpaced gold. What we are witnessing is not a speculative frenzy, but a structural rebalancing from leverage toward tangible ownership.
Well, the reality is all of the data is extremely murky, And we're not just talking about the gold and silver markets. I think the gold and silver markets are actually the headlights to see what's really coming, because even, today we got out the GDP report, and this is the best report since 1979, except there's no good data that's coming through for anything. So I feel like we are inside of a race car. And it's pitch black out, and we have no headlights. We don't know where we're going. You use the gold and silver as those headlights because that's really what's screaming that there is a looming crisis. We just don't know when we're going to hit a wall. And that's why it's so critically important to lay that foundation of physical gold and silver in your possession, not those digital or paper contracts. No, it's so much bigger than this. And even though we've seen that run, the reality is that and the reality is too that gold and silver have been outperforming most other intangible assets since what, 2000, 1999, right? But it's been hidden up until recently. So, I don't think we're getting any good data on anything, not that we did before, but now with all of the cuts that happened in the US government, we're getting even worse data than we were. We're flying blind. You can't believe anything that they're saying. So yes, I think all the data is murky, even as to who is really pushing it. Is it the ETF market, or is that just a reflection of the retail demand on this? But I can tell you, I think in the physical markets, we're definitely seeing demand go up a lot. I wouldn't say exploding yet, which means I think there's a lot more to come next year.
Economic data today is increasingly unreliable. Headline GDP numbers look impressive, yet they conflict with lived reality, slowing growth, weaker employment trends, and declining purchasing power. Investors are effectively driving through darkness without trustworthy instruments. In that environment, gold and silver serve as financial headlights. Historically, they have signaled stress long before crises become obvious. Their steady outperformance since the late 1990s has largely gone unnoticed until recently. This divergence suggests that markets are quietly pricing in systemic risk. When traditional indicators fail, precious metals often reveal what official statistics attempt to obscure.
I would have thought, and actually, as high as that may sound, the true fundamental value, what you're talking about is the market's intrinsic value. And you don't get good price discovery on any of that. But really, let's kind of talk about the squeeze a little bit, because we're looking at two different markets, but we're talking about them as if they're the same market. So there is the trading market, and that's really where that squeeze that you're talking about comes in, because it's just been like Wall Street always has to have something to hype, right? So they're funneling into the silver contracts, the gold contracts. However, in the real world, both silver and gold are used in every single sector of the global economy. And so in the manufacturing sector, when you're looking at the slowdown in the global economy, that's where you would not see a squeeze, but there needs to be. And to me, a squeeze doesn't necessarily mean that there is a top on it and then it's going to implode. In terms of contracts, that could be applicable. But in terms of sound money, physical gold and physical silver, when demand in one area, let's say it's the manufacturing because of a global slowdown, happens in this area, well, look at what the central banks are doing.
Much confusion comes from treating trading markets and real-world demand as the same thing. Futures markets thrive on hype and momentum, where short-term squeezes can form. But physical gold and silver exist in an entirely different ecosystem. These metals underpin manufacturing, technology, and monetary reserves worldwide. Silver is consumed, gold is conserved. A slowdown in manufacturing may ease pressure in one area, but central bank accumulation offsets it elsewhere. This is why a squeeze doesn't signal an end. It signals scarcity meeting sustained demand. Paper contracts can multiply endlessly. Physical metal cannot.
For themselves. And if you think we're actually even getting any good data there, there is this bridge in Brooklyn I could sell you. I don't own it, mind you, because the central banks have been accumulating gold at basically the fastest level in history over the last number of years. But that accumulation really started in 2005. It did not just start. And that coincides with what happened with the great financial crisis in 2008. That's when it became visible. It was happening before that. And I think that that's really what those gold and silver, the spot prices are telling us, is that something extraordinarily nasty this way comes. That's why I said, that's the headlight, right? That's what's giving you clarity and safety. And yeah, there is going to be a squeeze, but that's because there is, unlike those gold and silver contracts, there's a limited amount of this stuff. Silver does get used up in production. Gold is recoverable. Gold is the primary currency metal. Silver is the secondary currency metal. And I will tell you this, because very often in my work, I go to a currency converter chart. And I'll look at whatever, go to whatever one you want, pick any currency at all that you want, and then you do it against the US dollar, you do it against spot silver, and then spot gold. Now, typically when I've done this in the past, what we have seen, I would say about 99.3% of the time, is that spot gold always outperforms spot silver, and spot gold always 100% of the time outperforms the US dollar. And that is certainly happening in terms of the US dollar. But what we're actually, and I know your viewers are going to want to know this because this is a big question that comes up all the time, is that gold and silver ratio, which was like this. I mean, it was off the charts. That's why you can't even see my hand. And history shows us that as we move toward hyperinflation, what we see is that narrowing of the gold and silver ratio. But then again, once we are firmly entrenched, I should say, and the hyperinflation becomes more visible, then it's not that you're going to see that widen. You're just going to see, probably, if history repeats itself, you're going to see gold outperform silver because it's the primary currency metal. And that is against which they revalue those currencies, which is another interesting point because you never hear the talking heads in the past talk about that revaluation trade. And now that's such a good thing. It may be for traders, but it's not for the normal person out there that is struggling to feed their families and to pay their mortgage and their debts and build a life. I mean,
for years, central banks have been accumulating gold at historically aggressive rates, a trend that accelerated after the global financial crisis. Their true mandate is not public protection, but confidence management, keeping wealth anchored inside fiat systems. Currency revaluation is often framed as a benefit, yet it only occurs after trust has been destroyed. History shows that hyperinflation doesn't arrive overnight. It creeps in while confidence erodes quietly. Gold and silver ratios compress as this process unfolds. When revaluation finally happens, it is not to save households, but to reset the system itself.
Yeah, let's talk about that because people think that they can just go ahead and revalue just like that. And it doesn't really work like that because as soon as they do that, is that really going to pay off the debts that they continue to grow? So if you think about it like an individual getting credit cards in the mail when you know you're going to declare bankruptcy, more debt, more credit because you know you're not going to pay it. And so, yes, there's not one little doubt. I'll even go as far as giving you 100%. okay, which is not something I can do often. But 100%, we do see a revaluation in the future, but not until we have hyperinflated away the rest of the value that yet remains, the rest of the trust and the confidence that yet remains inside of the system. So I pay a tremendous amount of attention to that consumer confidence and sentiment, and the inflation expectations and all of those indicators, because I personally believe that the hyperinflation has already begun. It is just not yet visible. So what we're seeing today, and especially the fact that you've got, what's the central banker's real job? It's not to protect you or me. My goodness. No, 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 no. That is a private, they are all private corporations. That is to keep your confidence in the system so that you keep your wealth in that intangible fiat money products, and it's easier to transfer your way. And so when you're looking at really what's happening with the central banks, and Italy's brought up a really, really interesting point that I want to talk about in just a second. But when you're looking at the central bank guidance, none of them are really independent. They want you to think that they are. And so, Fed Chair Powell is fighting it. And with the new GDP report that just came out, it's going to be harder to justify dropping those interest rates to create more inflation.
As confidence weakens, a parallel transformation is underway. Governments and banks are rapidly advancing digital currencies, stablecoins, and tokenized assets. This push coincides with stagnation across much of the crypto market, suggesting coordination rather than coincidence. Even institutions once hostile to digital assets are now building infrastructure behind the scenes. The goal appears less about innovation and more about control, efficiency, traceability, and compliance. Historically, systemic resets require visible crises to justify radical change. If that pattern holds, tangible assets like gold and silver may remain critical anchors as the global financial system transitions into something entirely new.
However, we're also looking at a major slowdown in employment, and that also would justify dropping those interest rates. But then what does that do? It speeds up what the inflation rate, and the public is already distrustful. The confidence level just keeps kissing that all-time historic low, and I'm waiting for when that breaks through. That will be that hyperinflationary debt clock. It's the timer's already ticking. But when we go to the lowest level and we break that support confidence level, then for me, it is absolutely game over. It is game over. And they will then hyperinflate away the debt. So they repay that debt with, in the US, dollars that have no value, or euros that have no value, or yuan or yen or whatever. And I do think this is going to be a globally coordinated effort. Once that takes place, that's when they will use that gold revaluation account that every single central bank had. They can use it in little bits now, but the big one is to reset us into a completely new system. So they have to have that very, very visible hyperinflation in order to do it. They need that very, very visible crisis in order to justify it. And, let's face it, one thing that I think is extraordinarily interesting that's happening right now is this massive global adoption in the banking sector and in the government sector, and this huge push into the cryptos, whether they're stable coins or they're CBDCs or whatever they are. It doesn't really matter. But we are seeing a massive adoption at the same time that you're seeing a major lag and even a bear market in things like Bitcoin or the other cryptocurrencies. So there's something that's going on here underneath the surface. And your guess on that is probably about as good as mine, but I do find it that bifurcation between I mean, what are they doing? Are they trying to hide what's really going on here? Because even JP Morgan, who once called them pet rocks and of course didn't like them at all, boy, they're ready with their stable coins, with their tokenization, and now they're talking about setting up crypto trading platform. Yeah. Where are they hurting us? Where are they pushing us to? Full surveillance on a global scale.